G'day and welcome to the F Word discussions where we talk about everything finance. It is tax season, interesting time of the year, January and February, before it's the end of the tax year. And also we have PJ back, the tax man, so I'll give him a question of the week. But also this will be the last time we have this format. We have an exciting new format coming next week, but we'll inform you about that next week when we show you what we've got in store. PJ, I've got a question in the week and I want to pose it to you. Some of the people might have heard, or the client asked, the 100,000 Rand donation that you can make per year. To each individual that 100,000 they can donate. Just practically, how does it work and who can you donate to? Do you just transfer the 100,000 Rand to a family member, or practically, how does this work and how do you then submit it in your tax returns? That is our question of the week, the 100,000 Rand donation. Thank you, PJ. We look forward to hear what you have to say.
Thank you, Joe. Yes, so it's important to note there's no donations tax between spouses. So that's why if you are married, it doesn't matter if you're married in community of property or out of community property with accrual or not without accrual, doesn't matter. You can donate to your spouse. So that's a very smart thing. Let's say you are the high, let's say income earner and you're in a high tax bracket and you want to buy another property, want to invest in money market, you can donate to your spouse R1,000,000 and they can invest it in their name and then you can get that tax rate rebates. So that's very important to note because, and that works basically the same on estates as well. You can say your spouse gets everything, then there's no estate tax as well. So donation tax and estate tax is quite close to each other because even donation tax you only pay when you are alive and estate tax you pay when you're dead. So that's a big difference. And it's also 20% each. So that's very important to note. So if you want to give to someone else other than your spouse, let's say for a trust or children, is a definite example. Then you have 100,000 Rand. And especially for high net worth people, if people that's estate's going to be bigger than 7 million, and where we get to the 7 million is each person has got 3.5 million, and then your spouse also has 3.5 million. So that's where the 7 million comes from. Then you want to start make use of the donations to give while you are alive, that 200,000 each year. And it doesn't sound much on that amounts, but if you, let's say you do 200,000 Rand each year for 10 years, it's 2 million Rand. So it's a great thing to minimize your estate. Practically, it's a bit more difficult. Yeah, you don't say on your income tax return, because in the income tax return, it's more about donations to Section 18, and you get a deduction on your income tax. This is not what we're talking about. The 100,000 you donate, you can't deduct that from your income. You can only donate of 100,000 and don't pay donations tax. So it's actually a totally separate tax return. There's a donation tax return. For most people, don't complete that, so you don't have to worry about that. But just be cognizant of the fact that you can only donate 100,000. A lot of people, when we work with trusts, we actually do a resolution or a deed of donation on paper. So it's not something that you submit anyway. You just say, I'm going to donate 100,000 Rand to my trusts, and this is what we do. And for children as well, you can donate, say, let's donate tax-free savings for them, 36,000 until you get that 100,000 Rand. So that's practically how it works. So it's actually very grey. A lot of people don't do that. But if you want to get in and be clear with the tax man, with SARS, that's the way you have to do it. Deed of donations. If you want to loan the money, that's something else, but that's a thing. So it is actually not that easy, and then most people don't submit it on the tax returns, but that's how you have to do that. But yeah, it's definitely not that easy. Happy?
Yes, thank you for clarifying that, PJ.
Okay, so yeah, what I'm going to talk about is more on the share side. So let's say you, and most of you, even if you're invested in a unit trust or retirement annuities invested in unit trust, you are invested in shares. And most of your portfolio, if you've got a longer term investment horizon, is invested in shares. In retirement annuities, it's capped, or pension funds, it's capped at maximum 75%. But where does growth in shares come from? We always hear on the news, they say the all share market or JSE is up 1.5%. For the year, it's up 18%. But what does actually that growth comes from? And growth in shares only comes from three parts. If you want to invest in a company, this is what you have to look at. You need to understand where the growth comes from. The first one is dividends. So if you own a share, almost let's say you're like a rental property, you own a property, you get a rental income minus your expenses, and that's what you get. The same with a company. If you invest in a company, the money, all the expenses there, and this is the part that they pay out for the investors, the shareholders. That you, if you own one share, you are the shareholder, and in a unit trust, that unit trust is a shareholder, and they have certain rights and things. So a dividend yield is something you definitely look at. And let's say good companies can give you 3-4% dividend yield. So let's say you can know you get that. So even if the market price go down, you know you can get your dividend yield. So that's number one, is dividend yield. Second one is earnings that you receive from the company. So let's say you invest in a company, Amazon, and they are generating a lot of earnings, a lot of income. They don't necessarily distribute it as a dividend yet for investors, but it's in the company already. They're just not distributing it because they use that money to invest in future products. But in the end, if you want to sell your share now, you will get that earnings. It's already priced in. So that things the market knows. They know this is the dividend, this is the earnings you get. And the third one, where most of the changes actually in the share price come from, is market sentiment. So even let's say you've got a good dividend yield and you've got good earnings for this year, and the market price is down 10%. It's definitely not because if there's a negative dividends, can't be negative, it's going to be zero. It's not about negative earnings because the company did create earnings, but it's because the market don't feel so good about the share anymore. They want to sell it. They don't believe it's going to grow in the future. And that's where the big growth comes from. So, and this is why I always say market timing is so difficult, because you can almost predict or not predict. You can read the financial statements or do an analysis, but this is where you do the analysis on the dividends and earnings. But market sentiment is a very difficult thing to time. So when we do share investing, we normally look at those first two, because in the long run, you know the company is, the price normally follows the earnings. It caught up. Maybe sometimes the price runs away and it comes back again. But in the long run, if you've got a company that continues to grow, continue to make income, think about, again, a rental property. If you've got a good property and you can rent goes up 10% each year, you know that's a good property. And when you want to sell it, people will want to buy it because you get a good yield. So that's the thing. In the long run, that's what you want to look at. You want to invest in quality shares. And sometimes companies are cheap. And when we say it's cheap, because you don't have to pay that much, like a PE ratio of, let's say, 8, for that earnings that you get. You pay 8 times the earnings that you get per year. But sometimes it gets more expensive. But that's where also, it's just an indicator of where the market is. Is it cheap or is it expensive? But remember always when you look at shares, those three things. That's just on a side note, why something like Bitcoin is very difficult to evaluate. If someone asks what's the price of Bitcoin, because you don't have any dividends in Bitcoin and you don't have any earnings in Bitcoin. So the only thing that's driving Bitcoin is the market sentiment. Is the value, or will I be able to sell it for more in the future than I'm buying now? That's the only thing that's driving. And the same with gold. Not saying it's a negative thing. It's just very difficult to evaluate, can I invest in Bitcoin or not? Because it's very different than shares. Joe?
Yes, thank you very much, PJ. Before I give over to Ruvan, yeah, I like the example of Bitcoin there, but especially the market sentiment, we see it a lot when a CEO steps down. There's an influence on the share price. It's nothing to do with the earnings or the dividends being paid. And Elon Musk putting a tweet out there about Tesla, that fluctuates the market, and that's completely about the sentiment of the market. It's got nothing to do like with the first two you mentioned. So it does play a big factor. Normally it's a knee-jerk reaction, it's a short reaction, and then it will stabilize, continue back to the dividends and earnings being paid. But thank you. That's quite an interesting take on it. Ruvan, over to you. What do you have for us today?
Thank you. Yeah, so it fits in quite well with with what PJ just spoke about. It is currently, as some would call it, the earnings season in the USA. So that one point that PJ spoke about, how you can earn an income, or how a share grows, or how you see the value of a share is the earnings of the company itself. So quite interesting. There's been quite a few good ones already. Today it's Microsoft and Alphabet. Alphabet, of course, Google. Wednesday, which is tomorrow, Novo Nordisk and Mastercard. Thursday, Apple, Amazon, and Meta. So some of the big names that will be putting their earnings out in this week. But we already had quite a few large ones as well, specifically in the financial sector. Last week was Tesla as well. But in the last 2 to 3 weeks, JP Morgan Chase, Wells Fargo, Bank of America, Citibank, Morgan Stanley, Goldman Sachs, BlackRock. All of the earnings already out. Some of them looking quite well. I think with the banks, especially, you can sort of expect higher earnings when interest is high. When the interest rate is high. So you've seen that come through, but some of these players on the S&P 500 really not bringing their part in the actual growth of the index itself. Of the S&P 500, it's more the Magnificent Seven still doing the hard work. But we'll see what happens. One of the predictions for 2024 around the S&P is that it will reach its all-time high again. So we saw that in 2023, and the prediction is that we will see that in 2024 as well. Of course, there are major things happening all across the world, major geopolitical things happening, and let's see what happens. There's quite a few things that can throw the apple cart over. We'll see what happens. But I think the overall sentiment in the market is positive, if I can say positive, or cautiously positive, cautiously optimistic. But let's see what happens. During this time when earnings season is upon us and some of these major companies put their earnings out, it will definitely be volatile. Why is it volatile? Because they are speculative and institutional investors that will definitely take advantage of these short-term moves, especially the day before the earnings or the day of the earnings of these companies, and the day probably afterwards as well. So there will be major moves which will definitely be volatile in the markets. So that begs the question: where does this actually fit into our portfolios, or into a retail investor's portfolio, the normal person on the street that will be looking at this video? Where does it fit into your portfolio? And I think always our answer would be long term. But what does long term mean? Long term can mean 10 plus years. I think it depends on how each person's position looks, and how your own portfolio looks. But I think that's where it's quite important, and that's where financial planning and investment planning comes into portfolios. You can't invest in shares when you need liquidity for emergencies. Investing in Tesla, as an example, owning Tesla shares in a flexible investment or a share portfolio that's intended for emergency funds is probably not the best advice out there. Why is it not the best advice? Because the risk of losses when you need the money is high. You need long-term growth. You need a long-term position in order to realize gains in the future. It will be difficult in the short term to make money, and therefore it's probably not the best thing for a short-term portfolio. So definitely it will come in long-term growth, where you actually want growth that is more than inflation, growth that will increase your net worth. That's where shares form parts of a portfolio, and that would definitely be more in the long term. So very important to remember that every single asset that you can own as an investor has an investment horizon. And exactly like I said now, shares is definitely a longer term investment, and that should be that part of your investment, the growth part, the longer term part of your investment. Very, very important.
Yes, thank you very much, Ruvan, for clarifying that. And I like what you said towards the end. It depends on each person's specific circumstances. What you've said here is not financial advice, it is just general comments. Financial advice is very personal, and that's why it needs to start with goal setting. What is your goals for the new year? What do you want to achieve with your money? And then only can you see what asset allocation will you, what's my time horizon, etc. So make sure you get personal financial planning and don't just listen to this and now implement it in your own capacity. But thank you very much, gentlemen. All the best. We will see you next week, or we might not see you next week. But we'll chat soon, and all the best. Enjoy the weekend.